Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Shaun Richards of Not a Yes Man Economics, and we're now going to talk about the Bank of England. This is on the back of more dovish statements than possibly some had expected last week, and that was reflected in the sell-off in the pound. The Bank of England feels now it's at a crossroads. It keeps talking itself into a corner. Where do the Bank of England go?
Well, I think they've got themselves into a bit of a cleft stick, as in the fact if we go back in time, 3 or 4 years, a theory came up, and it actually came up in something that's going to be along in a few weeks, the Jackson Hole Conference, that central banks could change things simply by what you could call open mouth operations. By saying it, people would believe it, anticipate it, markets would move. Now, in the very short term, some of that did actually happen. People think back to the Mansion House speech in 2014, and I think pretty as exact as I can remember it, Bank of England Governor Mark Carney said, sooner than markets expect, which everyone took to mean that interest rate rise was around the corner. And markets then moved. Pound, my old stomping ground, short sterling, which for those that don't follow it, is an interest rate predictor for markets. But since then, they've come to a problem, which is if you keep promising something and you don't do it, then people lose faith. Even worse, of course, from that point of view, they cut rates rather than raise them. And then more recently, we've seen the Bank of England try this again. But some of this, I think, frankly, got silly. Okay, maybe Governor Carney's trying the same rule book, I think playbook, excuse me, I think God knows why. But even some of those like Chief Economist Andy Haldane, the one who only last year said we needed sledgehammer QE, we needed to ease everywhere, we'd ease again in November, we didn't. Now he's suddenly saying there's a case for a rate rise. I don't think anyone ever really believed that. And now he just looks foolish. He swung both ways of the thing, panicked after the EU leave vote, then sort of hinted at a sort of panic this summer. And the reason why I'd call that panic is, it's not only what you do, but when you do it. If you look back and you wanted to respond to the inflation saga of this year, then you needed to raise rates last August, not cut them. People see my work, I say this back then, dropping the pound was going to lead to inflation. And so now it's in a mess. One of the biggest ironies this week's led to me having a wry smile is the Bank of England sort of raised expectations, and then, as you say, pounds dropped back, those that believed it, given up. And then we've seen some recruitment agency things saying that wages are picking up. So they've sort of stuck themselves in all directions and are just confused, I think.
So the Bank of England needs to be decisive, potentially. So if we had an interest rate hike, how would that be taken by the market at this point? If we saw a quarter-point hike, would the market say, well, actually the MPC, they've taken a view, they're doing something about it, rather than talking up a hike? Or would the market then say, actually, you've just done this as a reaction, we don't trust you?
I think we would see a bit of a bounce in the pound. You know, at the minute, it's very weak against the euro. I think about roughly around the weakest we've been for a while. So that would create it. It would change a few other things, not massively so, because, again, what confidence would people have that they'd do more? But it would sort of balance and smooth things out. Where it then has itself, again, in a little bit of a cleft stick, is things like the term funding scheme and other things it's given out as subsidies to the banks. It would make that area more uncomfortable for them. So again, it has sort of really rather trapped itself. And we then, again, face the problem, what does it actually do should the economy genuinely slow down? For all the scare stories of this year, and I don't personally think that 2017 will be any year to write home about for the British economy, but we've more or less continued to grow, albeit only a little bit. So it's not been the end of the world, just not very good. Well, what then does it do if we reach a point whereby you see a genuine slowdown? Something happens, goes wrong somewhere. What do? Last time round, they cut interest rates by 5%, roughly. Where would that put us?
Yes, indeed. Or more QE spending, but you know, how much can they spend?
Well, there's a finite limit on the QE factor, not just on the size of the gilt market, which they already have a bit of, but quite a bit of it is in what you'd call firm hands. What I mean by this is, say, annuity providers, hedge position, pension funds and that. So their actual scope to buy more, probably a bit less than people think.
On that note, Shaun, thanks very much for joining us.
Thank you.